Hi, this is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. And in this episode, I'd like to talk about, is it safe to borrow to invest in shares? And if so, what is the best way to do it? Now, borrowing to invest in property is a really common investment strategy in Australia, and it's often seen as a less risky strategy than borrowing to invest in shares. But really, we shouldn't be so quick to discount borrowing to invest in the share market, because really I think if you stand back and think about the long-term returns in terms of total returns, income plus capital growth that you might generate from investing in property and investing in the share market, I think it's a reasonable assumption to assume that the total return is likely to be similar. That is, that neither asset class sticks out to say, look, this is a better asset class or likely to earn better returns. Now, there's pros and cons with each, and they are very different, and the makeup of the return will be different as well in terms of the amount of capital return versus income. So there are those things. But in terms of which asset class is better, which one is going to generate higher returns, I think the safest approach or the most conservative approach is to assume that they're both going to be good quality asset classes to invest in. Now, the first thing I want to talk about is really the power of gearing, because that's the thing that we're really most interested in. It's not really the underlying asset that's doing all the heavy lifting. A lot of the heavy lifting is done by gearing of itself. And I have recorded an episode where I've talked about this. Of course, the link is on the blog on the website. And I did a financial analysis to try and isolate what are the components of return. So if we borrow to invest in property, how much is the gearing adding? How much is the income adding? How much is the capital growth adding? And so on and so forth. And I concluded that around 45% of the total return is generated because of the power of gearing. And that's not because of the property itself, but it's really just that element, that strategy to borrow to invest, which means that I'm going to use someone else's money. I'm going to pay an interest rate for that money. But the hope is, and particularly with compounding capital growth, the hope is that I will earn a greater return than what the interest rate costs me over time. Now, the big difference, obviously, with borrowing to invest in property and borrowing to invest in shares is that if you're doing it with property, and assuming, and I hope it's the case if you're listening to this podcast, assuming you're going to buy an investment grade property, you can't go out and borrow $100,000 and go and buy an investment grade property, of course. It's probably closer to $1 million than $100,000. So you're really forced to borrow a substantial sum of money to be able to implement the strategy safely. That is, to buy a really high quality asset. Now, if you're not going to buy a high quality asset, then I think borrowing to buy an average or below average quality asset is a very risky strategy, because it's not going to work, and you'll probably end up magnifying the returns, because that's what borrowing does, and you end up magnifying very ordinary or possibly even negative returns. So really, if we're comparing property versus shares, the answer is that if we want to do property, we've got to borrow a hell lot of money. Now, there's a pro and a con to that. The pro is it forces people to invest more sooner. And if you invest in the right asset and hold that asset for long term, you'll actually be miles better off. So, if we just notionally, when we turned 20, borrowed $1 million and bought a property for $1 million and held that property for the next, 40 years, and that asset's a good asset, we would make substantial amounts of equity, right? And, borrowing $1 million when you're 20 is a lot of money. It's probably impossible for most people, but that's kind of the point. That's kind of the pro, is it does force us to invest more sooner and take on slightly more risk. The con is that we're locked into that commitment. So when you go out and borrow $1 million and go and buy an investment property, and you work out that's going to cost me $50,000 a year pre-tax to fund in terms of the negative cash flow, that's a commitment that you've got to meet. It's not going to go anywhere. If your circumstances change, well, there's limited things you can do to accommodate that, and maybe you'll be forced to sell an asset. Whereas borrowing to invest in shares is much more flexible, particularly if we're going to invest in a number of tranches over time. So say on a monthly basis, we can dial up or down the amount of borrowing and the amount of investing we can do, and that's quite flexible. Now, when comparing borrowing to invest in shares and property, there's two things that really stick out that are main differences. The first one is the share market has higher volatility than the property market. In fact, it has almost doubled rate of volatility. Now, that means that, volatility over the long run doesn't really matter. That an asset's volatility or asset classes volatility, if I invest today, close my eyes, wake up in 30 years' time, and then go and sell that investment, chances are, because that's a 3-decade period, I would have experienced many cycles, many changes, many differences, etc. It would have all evened out, and the long-term returns likely to be close to, the long-term average return return, and it's probably worked out for me. In fact, there's a very high probability over a time period like that I've done well or achieved the returns that I've been looking to achieve. Volatility doesn't really worry us too much in the long term. It's really the short term. And so if we're borrowing to invest in an asset that has high volatility, it's entirely possible that we do that and it doesn't achieve a net return for the first 5, 7, even possibly 10 years. Especially, for example, if we borrow to invest in the share market, dump it all in the share market tomorrow, and then we wake up the next day and the share market's dropped 30%. It might take a number of years to obviously recover that loss, notwithstanding then you're paying the interest cost on the loan, and it takes a bit of time to sort of catch up, and 5 years from now you could be no better off. Now that strategy will still work if you stick with it for the long term, but that's the impact of volatility in the short run. Whereas with property, because of its lower volatility rate, the chances of a negative return in a 6-month period is, there's a chance there. Over a 12 or 2-year period, there's a very low chance you'll experience a negative return. And so your downside is limited, whereas not with the share market, your downside is much larger. The second difference is it's a lot easier and cost effective to borrow for property. So obviously banks will lend 90-95% of a property's value, which means you only have to contribute 5-ish% plus costs. And the interest rates compared to the interest rates for borrowing to invest in shares are a lot lower than what they are with shares. Okay, so if you acknowledge all those differences, then you still think, yes, Stuart, I think it's a good idea. Let's do that. And I'm going to talk about how to combat volatility and how to implement the strategy, later on in this episode, of course. But there's really 3 options that you can consider that you can use to borrow to invest in shares. So the first option is what's called a margin loan. And these were much more popular, 15 years ago before the global financial crisis, but have become a lot less popular and fewer banks and share brokers offer them these days. But essentially a margin loan is much like a mortgage where you go and borrow to buy an investment property, for example, in that they will lend you a certain percentage of the asset's value. So if you have a share portfolio of 100,000, depending on the makeup of that portfolio, a margin loan lender might lend you somewhere between 60 to 70% of the gross value of that portfolio. But there's 2 differences between a margin loan and a normal sort of property finance investment mortgage. The first one is that the interest rates are higher. They're close to sort of 9.5-10% at the moment. So they're probably 2 or 3% higher than investment mortgage rates. And also they're subject to margin calls, which means that if the value of your share portfolio falls and it breaches the margin that the lender's willing to lend you, that 60 or 70%, you have to reduce the loan. And now because the share market has higher volatility, you really need to prepare for that. So if you're going to use a margin loan, you wouldn't necessarily go and borrow the maximum, 60, 70%. Whereas if you're going to invest in property, most people typically borrow the maximum, 80, 85% without mortgage insurance, because you're never going to get a margin call, because margin calls aren't a feature of mortgages. So margin loans are a potential option. The second option I want to talk about was borrowing against equity in existing property. So for example, you could go off to your bank and say, okay, I've got this equity in my home or investment property and I want to establish a second investment loan account and borrow at mortgage rates. And you could certainly do that. As I said, mortgage rates are about 2.5% cheaper than margin loan products. And also you're not going to be subject to the risk of margin calls as well. So that's a better opportunity, assuming you have equity in property and some borrowing capacity. That's a better opportunity than a margin loan. And the third option I wanted to talk about was what we would call internally geared investment products. And most of these ETFs, exchange traded funds. I've produced a episode talking about the benefits of exchange traded funds. And of course, I've got the link to that blog on the website. But essentially, these internally geared ETFs allow you to invest in certain geographical markets. And inside the actual investment, they will borrow around 50 to 65% as well. So they add the gearing already into the product. And so there's really 3 main advantages to internally geared products. The first one is interest rates are quite cheap. They're around about 1 to 2% lower than investment mortgage rates because they're borrowing at wholesale interest rates. So they're really cost effective. You don't have to muck around with getting a loan, or the hassle of margin calls or anything like that. And the third benefit is it doesn't actually impact your personal borrowing capacity because obviously the gearing's non-recourse in the actual loan product itself. So it doesn't impact on any other plans where down the track you want to upgrade your home or invest in property. That gearing's quarantined within the product. Now, there's only 3 internally geared ETFs offered on the Australian market. market, and I've got the links and the ticker codes in the blog on the website. There's two offered by Beta Shares, one that invests in the Aussie market and one that invests in the US market, and there's one by Van Eck that's an equal weight Australian geared fund that's a relatively new product. So it's very limited. That's the only downside with internally geared ETFs. The investment menu is very limited, and so you want to sort of consider that, and I'll talk about that in a second. So if you're interested in implementing this strategy, there's probably two sort of tips I would like to share with you to sort of manage, how to manage the volatility, because that's the main thing, right? That most people think, well, I don't want to borrow to invest in the share market because I know it's really risky, it's very volatile, it could crash tomorrow, and it doesn't make me feel that safe. So how can we deal with that? So there's two things you can do. The first one is that it's probably best to spread your money over a long period of time. So invest it on, say, a monthly basis. And it really does help spread that timing risk. And if you do that for the next 10 to 20 years, for example, it means some months you're going to invest in the market when it's relatively expensive, and some months it's going to be relatively cheap, but it'll all sort of even out in the long run, and you kind of spread that timing risk. The second thing you can do is be conservative with the amount that you're borrowing. So I tend to not exceed a 50% loan to value ratio, which means that, hey, if I want to invest $5,000 of my own cash savings every month, then I might match that with another $5,000 of borrowed funds. And so therefore I've got a sort of 50% sort of LVR. And that way, if the market kind of crashes, my savings or capital's at risk, but at least I don't risk falling into a negative equity position. Now, borrowing to invest in shares is going to work out better from a cash flow perspective as well. And the reason for that is that obviously we get higher yields, so dividend payout yields are higher. So the amount of income you get from shares is higher than what you get from property. There's imputation credits that tag along, particularly with Australian shares and to a much lesser extent international shares. And there's no related expenses. There's very few expenses associated, other than interest associated with running a share portfolio in comparison to property. So for example, the ASX 200 index has yielded around about 4.5% per annum in terms of dividend income. And since about 80% of that has franking credits attached, it really equates to a pre-tax income yield of around 6%. So if you compare that to property, for example, property is probably close to 1 to 2%, whereas Australian share market anyway is close to about 6. And so I worked out that if you borrowed 50%, so kept your loan to value ratio at 50%, invested 60% of that money in the Australian market and 40% in international market, I estimate the portfolio would be slightly cash flow positive by about 0.5%. Whereas if you had a 50% LVR and invested in property, your cash flow position is going to be negative. It won't be hugely negative probably, it depends on the asset and location, but it still will be negative. So it's really positive, excuse the pun, from a cash flow perspective as well. Now, I've included a chart where I kind of back tested a strategy. So it's reasonable to ask ourselves, how would this potentially work out, if I implement a gearing strategy? And so what I've done is had a look at sort of back testing one and assumed that we commenced an investment strategy in 2001, so just over 20 years ago, and we invested $2,500 of our own money plus $2,500 a month of borrowed funds, so kept that gearing rate at 50% with an initial investment of $10,000 just to sort of kick it off, if you like. And I benchmarked that against the index to sort of work out, well, what would the returns been? And a few different observations. So between 2001 and 2009 or 10, we wouldn't have actually made any money. Our portfolio would have been worth exactly what we contribute to it. We're not in a loss position, but we're certainly not in a profit. And obviously that's because we had the GFC crash that sort of wiped out a lot of the returns. But if we had hung on to today, it means we would have invested just under $500,000. So that's of borrowed funds and our own cash. And the net value, so net of the debt and so forth of the portfolio, would be worth about just over $1.7 million. So really we've taken that $500,000 of capital and more than tripled it over that long period of time, noting that there's been periods with much higher volatility that have impacted the returns. But I think what it demonstrates to us is that it is a very long-term strategy. All strategies should be long-term, but investing in share markets and investing in a market that has high volatility, you really do have to stick it out for long-term. And I'm talking about 2 to 3 decades plus to really enjoy those really strong returns. So to wrap up, how would I implement this if I was in your shoes? Well, it depends on how much you're expecting to invest in the share market. market. So if you think longer term, if you think over the next sort of 10 to 20 years, the portfolio is going to be less than $500,000, I'd probably stick with internally geared ETF products. They're cheap, they're easy to use, there's no margin calls, and whilst the investment menu is limited, that shouldn't really worry you too much. However, if you expect your portfolio to exceed $500,000, particularly over the next 10 plus years, it might be better off to use a financial advisor to construct a portfolio for you and manage that portfolio over time, because having a wider investment menu, including some rules-based index managed funds as well, and being able to diversify across sub-asset classes and geographical markets and using different indexing strategies should help not only reduce the risk in the portfolio but also maximize returns. So it just depends on where you think you're heading and sort of how much you're putting into the market will dictate which is the best approach there. Okay, as always, thanks for listening. And before you go, just to let you know, I have mentioned in the past that there's a discount code in the show notes to buy one of my books for $20, including postage. And unfortunately, that coupon hasn't been working, but we had the IT nerds fix it. So that coupon is blog. So if you follow links in the show notes, you can buy one of my books, $20, no postage. And that code actually works now, which is kind of convenient. So I apologize for the inconvenience. Anyway, until next week, bye for now.